Welcome to the Bulls 2 Bears Insider Trading Podcast. Viewer discretion is advised.
Hello everyone, welcome to another episode of the Bulls to Bears Insider Trading Podcast. I'm your host Frank the Bull from bullstobears.com, and I'm here to explore the intersection of politics and investing with you. Today we're diving into a particularly intriguing topic: how a presidential election year might impact the stock market, why many investors choose to sit on the sidelines, and why this strategy is a big mistake. We'll also take a closer look at what a Donald Trump-led stock market may look like if he wins, especially with his proposed ease of regulations. To add, I want to make a prediction on this year's election. I do believe Donald Trump will win in November. This is solely based on history. To win in November, Camala Harris will have to defy history, because only once in the last 188 years has a sitting vice president been elected president of the United States. The only sitting vice president to win the nation's highest office in this modern era was George H.W. Bush in 1988. So I feel Camala Harris is likely to face a challenging November due to several factors. Now, I could be wrong, but in my opinion, her extreme progressive stance, while appealing to a niche segment of voters, alienates a significant portion of the electorate who may view her policies as too radical or impractical. This, combined with her perceived phoniness and cringiness of both her and her running mate, undermines her credibility and reliability. I believe many voters are turned off by her insincere demeanor and question her genuine commitment to her flip-flopping political issues. Kamala Harris's lack of authenticity, coupled with her divisive policy positions, creates a formidable barrier for her to garner broad-based support. And as a result of this, her campaign will struggle to build the necessary coalition to secure a win in this upcoming election. But time will tell. So buckle up as we navigate these complex and fascinating waters. Either way, Trump or Kamala, investing in stocks right now could be a strategic move due to the significant impact this political outcome will have on the market dynamics. Historically, financial markets tend to exhibit volatility and opportunity in the months and weeks preceding an election. Now, by staying engaged in the market during this period, investors can potentially capitalize on short-term price movements and sector-specific trends influenced by campaign promises and political rhetoric. Conversely, the halting of trading and waiting for election results can be a costly mistake. The financial markets are forward-looking and typically react in advance to anticipated outcomes, making it essential to stay actively involved rather than sitting on the sidelines. Now, if investors choose to stop trading and wait for the results, they risk missing out on significant gains that can occur in the run-up to the election. So by stopping trading, investors forfeit the opportunity to benefit from these movements and may find themselves out of sync with the market's adjustments post-election. Now, in my extensive 33-year experience, maintaining a proactive trading strategy through an election cycle has proven to be far more effective than adopting a wait-and-see approach. The key is to leverage insights gained from pre-election market behavior and adjust trading strategies accordingly. Once again, elections often bring a surge of trading activity and increased volatility, which can present opportunities for informed investors. Stopping trading can lead to missed opportunities and potential losses, as markets often correct rapidly in response to the election's outcome, leaving those who are waiting for a more favorable entry point less time to react to the new market realities. Now, presidential elections in the United States have always been a pivotal point for the stock market, and according to data compiled from various financial research sources, stock market performance during election years tend to show unique patterns. It is not uncommon to see increased fluctuations in the stock market during an election. However, once these results are in, the markets often experience a rally as investors gain clarity on the future direction of economic policies. Now, this can be seen as a relief rally where the market reacts positively to the certainty of the new administration's policies. Data from the S&P 500 index shows that the average return in election years is generally positive, though there are significant fluctuations. On average, the market tends to rise during the second half of the election year, reflecting optimism about the incoming administration. So why do investors sit out and wait for results? Now, while it's understandable to be cautious, sitting out of the market during an election year is a mistake for several reasons. One, missed opportunities. The stock market often experiences significant movements post-election, whether up or down. By sitting out, investors miss out on substantial gains during these periods of post-election clarity. Number two, long-term investment goals. Investment strategies should ideally be based on long-term fundamentals rather than short-term market fluctuations. Sitting out might derail long-term investment plans and goals. Number three, market timing risks. Trying to time the market based on political events can be very risky and often leads to suboptimal outcomes. Historical data shows that market timing strategies rarely outperforms a consistent investment approach over the long haul. Four, election results. They're not always predictable. Even with historical data, predicting how a market will react to a new administration is inherently uncertain. Investors might find that the anticipated market moves don't align with actual outcomes. Now, Donald Trump's last presidency run had a notable impact on the stock market, and speculations about a second term bring up interesting considerations. Number one, ease of regulations. One of Trump's signature policies was reducing regulatory burdens. And ease of regulations, particularly in sectors like energy, finance, and healthcare, could potentially lead to increased corporate profits and higher stock prices in these industries. Number two, tax policies. Trump's tax policies, including corporate tax cuts, were seen as beneficial for the stock market's performance and could provide a further boost to corporate earnings and increase investor confidence. Number three, trade policies. Trump's trade policies include tariffs and trade negotiations. They had mixed impacts on various sectors during his last administration. While some industries benefited from favorable trade deals, others faced challenges. Future trade policies would likely influence market performance in diverse ways. We shall see. Number four, market reactions. The market's reaction to Trump's policies would depend on their implementation and broader economic conditions. Investors would need to stay informed and be prepared for both positive and negative impacts. To navigate the uncertainties of an election, here are some proactive strategies us as investors can take. Number one, diversification. It's key. Maintain a diversified portfolio to mitigate risks associated with market volatility. Number two, focus on fundamentals. Stick to investments with strong fundamentals rather than reacting to short-term market noise. Companies with solid earnings, strong balance sheets, and substantial business models are more likely to perform well over time. Three, very important, stay informed. Keep up with political developments and their potential impact on different sectors. Understanding how policy changes may affect your investments can help you make more informed decisions. Number four, long-term perspective. Maintain a long-term investment horizon. Short-term volatility and election year fluctuations are part of the market's natural cycles. Number five, consult a financial advisor. Seek advice from someone like me, a financial professional who can provide tailored strategies based on your individual risk tolerance and investment goals. So navigating the stock market during a presidential election year can be challenging, but with the right approach, it could also present significant opportunities. While it's tempting to sit out during times of uncertainty, staying proactive and informed can lead to better long-term outcomes. As we consider the potential impacts of another Trump administration and the broader political landscape, it's essential to base investment decisions on thorough research and long-term perspectives. So therefore, keeping a steady hand and continuing to trade through the election cycle is not only prudent, but essential for capitalizing on market fluctuations and managing investment risk effectively. So thank you for joining us on Bulls to Bears TV for this in-depth analysis. If you found today's discussion valuable, please subscribe to our channel, smash those buttons, leave a review, and share this episode with fellow investors. Thank you for joining me on this episode of Bulls to Bears TV. Be sure to follow us for more updates and more in-depth analysis on how political events may influence the financial markets. Until next time, happy trading, everyone.